Welcome to the deep dive. Today we're looking at something pretty remarkable in the markets. It's a story that isn't just about, huge gains, but one that's really shifted the whole conversation around financial privacy online.
hmm
I mean, the numbers are just staggering. We're talking about ZCash, ZEC. This is a cryptocurrency that honestly was kind of languishing for years. It hit this rock bottom low. What was it, like 1575?
$15.75, yeah.
Yeah.
July 2024. It looked like it was practically finished.
Right, dead in the water. And then this absolute explosion happened. We saw a surge, you said, over 1,000%.
Over 1,000%. Starting around September 2025, prices shot past $600 and, yeah, briefly peaked at an incredible $748 on November 7th.
Wow, that's huge. And the big news wasn't just the price, right? It actually overtook its main rival.
Exactly. It surpassed Monero XMR, which had been the dominant privacy coin for ages. Zcash took the top spot by market cap. And look, this wasn't just like some random pump and dump. What our deep dive shows is that this huge shift, this resurgence, it's down to a convergence.
Yeah.
5 really specific, critical factors all hitting at once.
5 factors. Okay, what are we talking about?
We're talking about massive regulatory shocks hitting the privacy space, a deep philosophical split rocking the Bitcoin world, huge amounts of institutional money suddenly selling off Bitcoin.
Right.
Then you had these high-profile endorsements jump in, and maybe most importantly, Zcash's own technology finally, maturing, coming of age.
Okay, that is a lot to unpack. Definitely a perfect storm. But before we dive into those 5 catalysts, let's just baseline this for everyone listening. Maybe you're deep in crypto. Maybe you're just crypto curious. What exactly is a privacy coin? Why are we even talking about this now?
Good question. So fundamentally, a privacy coin is a type of cryptocurrency built specifically to protect your financial privacy. This is really different from Bitcoin.
How so? People think Bitcoin is anonymous, right?
That's a common misconception. Bitcoin uses addresses, not names, so it's pseudonymous. But here's the key.
Yeah.
Every single transaction, every amount sent, every address involved, it's all recorded permanently on a public ledger that anyone can see forever.
Okay, so not really private then.
Not private at all, especially now. There are sophisticated tools companies built entirely around analyzing that public ledger and linking those pseudonymous addresses back to real-world identities. Privacy coins, on the other hand, use advanced cryptography to deliberately hide the crucial details. Who sent the money, who received it, and how much was sent.
Got it. So if Bitcoin is like sending a postcard where anyone can read the message, even if the sender's name isn't directly on it,
Yeah.
a privacy coin is more like sending actual cash, sealed in a security envelope, no return address, completely opaque.
That's a great analogy. Exactly. And the reason this is so urgent right now, in late 2025, it's this pincer movement. On one side, as we'll get into, governments are getting really aggressive, actually prosecuting the developers who create these privacy tools.
Yeah.
And on the other side, you have this huge global push towards central bank digital currencies, CBDCs. Our sources show over 130 countries are exploring these. And officials are openly talking about features like, get this, holding limits on how much digital money citizens can even possess.
Holding limits. So the government could cap how much of your own money you can keep digitally.
That's the discussion. So you see, this push towards potentially surveillance-heavy government digital money makes the need for a private, censorship-resistant alternative feel almost existential for a lot of people.
Okay, so the need for privacy is clear. Let's dig into the history here. For years, this space was defined by a fundamental split, right? Monero versus Zcash. Privacy by default versus optional privacy. Let's start with Monero's approach.
Right. Monero's philosophy was and is pretty uncompromising. They believe that for digital money to be truly fungible, meaning every coin is identical and interchangeable, like dollar bills, privacy can't be optional. It has to be mandatory.
Why is optional privacy a problem for fungibility?
Their argument is, if only some transactions are private, then the coins involved in those private transactions start to look different, maybe even suspicious compared to the transparent ones. They lose that interchangeability. So Monero's solution: force privacy. Every single transaction uses their privacy tech, always. This naturally appealed to the hardcore privacy advocates, people who wanted maximum confidentiality, maybe even at the expense of practicality or regulatory acceptance.
And the tech behind that, you mentioned ring signatures earlier.
Yeah, that's the core of it. They use something called MLSAG, multi-layered, linkable, spontaneous, anonymous group signatures. Bit of a mouthful.
Definitely. Can you break that down simply?
Okay, think of it like this. When you want to spend some Monero, your transaction gets mixed in with a bunch of other possible transactions decoys. They call them mixins. The ring signature mathematically proves that someone in that group authorized the spending, but it doesn't reveal which one was you.
So it hides you in a crowd.
Exactly. It creates plausible deniability. The linkable part is just a clever trick to prevent you from spending the same money twice without revealing who you are. They combine this with Ring CT to hide the transaction amount, send stealth addresses to obscure the recipient. It's a layered defense.
Sounds pretty solid, but ZCash. ZCash went a totally different route. Much more complex, some might say controversial, with this optional privacy idea.
Completely different architecture, yeah. ZCash was designed from the ground up to support both transparency and privacy. It has tab addresses, which work just like Bitcoin addresses, public, traceable. But it also has Z's addresses, shielded addresses, which offer arguably the strongest privacy guarantees available.
And that's where the famous ZK-SNARKs come in.
That's the magic ingredient.
Yes.
ZK-SNARKs, zero-knowledge, succinct, non-interactive arguments of knowledge. Again, quite a name.
Huh. Yeah, let's pause on ZK-SNARKs because this tech is kind of a big deal now, way beyond just Zcash. How on earth do you prove a transaction happened without revealing anything about the transaction sender, receiver, amount? It sounds impossible.
It does sound like magic, but it's pure cutting-edge cryptography. When you make a shielded Zcash transaction, your wallet creates a tiny cryptographic proof, the ZK-SNARK. Anyone on the network can quickly check this proof, and it mathematically guarantees three things. One, you actually had the funds to send. Two, the transaction balances, no money created out of thin air. And three, you didn't try to spend the same money twice.
But the proof itself contains nothing.
Contains zero information about who sent what to whom or how much. It proves validity in zero knowledge. It's an astonishing breakthrough.
Okay, so Zcash offers this potentially perfect cryptographic cloak. Why then, as you said, did Monero dominate the privacy scene for so many years? If Zcash had the better tech, what was the holdup?
That brings us back to that core philosophical fight. The Monero camp argued quite loudly that Zcash's optional privacy was its Achilles heel.
How so?
Their point was, look, if only, say, 10% of Zcash users are actually using the shielded Z addresses, then those 10% stick out like a sore thumb.
Right, you're basically highlighting yourself.
Exactly. You're effectively saying, hey, look at me, I'm using the private feature. It shrinks the anonymity set, making analysis potentially easier. They argued that unless privacy is mandatory for everyone, it doesn't truly protect anyone effectively.
That makes a lot of sense, intuitively. But the Zcash folks must have had a counter-argument. They surely anticipated regulatory issues down the line.
They absolutely did. Their argument was that optionality, specifically a feature called viewing keys, was crucial for long-term survival and real-world adoption. A viewing key lets a Zcash user selectively reveal their shielded transaction history to a specific third-party, think an auditor, a regulator, a business partner, without broadcasting it to the whole world.
So you can choose to be transparent when needed for compliance or business reasons.
Precisely. This technical compromise, this ability to selectively disclose, was Zcash's bet on the future. They argued it made Zcash potentially compliant, usable in regulated environments where Monero, with its mandatory absolute privacy, could never fit. For years, this looked like a weakness, a watering down of the privacy ideal. But as we saw unfold in 2024 and 2025, that perceived weakness became its greatest strategic advantage.
Okay, this is where the plot thickens. The big Zcash comeback didn't start with some Zcash breakthrough, but with trouble hitting its rivals. You called it a regulatory shockwave. Let's get into that first catalyst.
Yeah, the ground really shifted starting in April 2024. The U.S. Department of Justice made a huge move, arresting the founders of Samourai Wallet. Now, Samourai was a well-known Bitcoin wallet focused on enhancing privacy using mixing techniques.
And the charges were serious.
Extremely serious. Conspiracy to commit money laundering, operating an unlicensed money-transmitting business. The DOJ alleged they'd facilitated something like $2 billion in illicit funds. It sent a chill through the entire developer community.
And those founders actually got jail time, didn't they?
They did. In November 2025, they received the maximum sentence, 5 years. Then, hot on the heels of that, in August 2025, Roman Storm, one of the co-founders of Tornado Cash, another major crypto mixer, was convicted on similar charges.
Tornado Cash was huge. This must have terrified developers working on privacy tech.
It absolutely did, because it directly challenged this long-held belief, almost an article of faith in the crypto world, that if you just write open source code, you shouldn't be held liable for how criminals might use it. These prosecutions blurred that line significantly.
I remember the DOJ put out some memo later trying to clarify things, saying they wouldn't just go after developers for user actions.
They did issue a memo in April 2025 offering some nuance, but frankly, by then, the damage was done. The message received by many developers was clear. Building powerful, uncompromising privacy tools carries significant personal risk now. You could face jail time.
So fear was spreading. People started rethinking tools that offered total, mandatory anonymity.
Exactly. Which leads directly to the second catalyst, the mass delisting of Monero. This wasn't just fear among developers, it was institutions actively distancing themselves.
The great delisting, you called it. What did that look like?
It was systematic. Exchanges around the world started dropping XMR. We saw figures like 60 privacy coin removals globally in 2024, but Monero was hit hardest. Delistings surged something like sixfold. Major players Huobi, OKX, and crucially Binance all removed it, usually citing vague reasons like failure to meet listing standards.
But the real reason was regulatory pressure.
Almost certainly. The compliance departments at these huge exchanges saw the writing on the wall after the Samourai and Tornado Cash cases. Listing a coin designed for mandatory, untraceable anonymity was becoming too risky.
And then Europe hammered the final nail in the coffin with MiCA.
Pretty much. The EU's markets in crypto assets regulation, fully active from December 2024, was explicit. It directly banned regulated crypto service providers, exchanges, payment processors from offering services for anonymous crypto assets. It even banned users from paying merchants with coins like Monero within the EU.
Wow. So Monero effectively got locked out of the mainstream regulated financial system in huge markets.
Completely. Its trading volume got pushed onto smaller, less regulated exchanges, places like Poloniex, Yobit. Our sources say nearly 40% of all privacy token trading now happens on these lower-tier platforms. It just crushed Monero's accessibility for everyday users and institutional investors.
Okay, so Monero's being pushed out. How did ZCash navigate this minefield? This is the safe harbor strategy you mentioned.
This is where ZCash's design choices paid off massively. Remember, the optional privacy, the T addresses and V addresses, and the viewing keys.
Right, the ability to choose transparency.
That was the key. Major exchanges like Binance found a compromise. They said, okay, we can't accept deposits coming directly from a shielded ZCash address because we can't verify the source for anti-money laundering rules.
Makes sense.
But T, they said, we can accept ZCash deposits if they come from a transparent T address. Even if that ZC had been shielded previously, the deposit itself was transparent, satisfying their immediate compliance checkbox.
So the optionality gave exchanges plausible deniability, basically. They could keep ZEC listed while technically following the rules.
Exactly. ZCash's architecture allowed for this crucial middle ground. Users could prove compliance if needed, using viewing keys. Exchanges could manage their risk by controlling deposit methods. It kept ZEC on the big liquid Tier 1 exchanges precisely when Monero was being forced off them. That regulatory arbitrage, that flexibility, was absolutely critical. ZCash became the default refuge for capital fleeing the regulatory crackdown on mandatory anonymity.
Okay, so regulation pushes users away from Monero's hardline privacy, but Catalyst 3 suggests they didn't just run back to Bitcoin. There was a deeper reason, a crisis of faith in Bitcoin itself.
A profound one. Our sources frame this as the cypherpunk disillusionment. Remember, Bitcoin's original promise, the whole Satoshi white paper thing, was about electronic cash, about peer-to-peer value transfer outside of traditional control. Privacy and autonomy were core to that vision.
But that vision soured.
It did, mainly because Bitcoin's transparency turned out to be its vulnerability. That public ledger we talked about, it's become a goldmine for surveillance. Companies like Chainalysis built multi-million-dollar businesses doing sophisticated tracking, linking Bitcoin addresses back to real people, exchanges, services. The pseudonymity just wasn't holding up. Even Vitalik Buterin expressed concerns ETH could degenerate into a tool for surveillance.
So the privacy promise of Bitcoin was fading. And then came internal fighting, this OPI return civil war.
Yeah, that really ripped the community apart in 2025. It was a technical debate, but it became deeply philosophical. It was about the OPI return function, which lets you embed small amounts of data onto the Bitcoin blockchain. The fight was over whether to increase the tiny 80-byte limit.
Why was that so contentious?
Well, the Bitcoin core developers, sort of the mainstream camp, wanted to raise the limit. They argued it was needed for innovation, things like Layer 2 scaling solutions, maybe even digital collectibles like ordinals. They saw it as progress.
But another faction disagreed strongly.
Very strongly. The more hardline sound money advocates, people like developer Luke Dashgier and his Bitcoin Nods implementation, saw this as heresy. They warned that increasing the data limit would turn Bitcoin's pristine monetary ledger into a dumping ground for random data, bloating the chain, increasing costs, and distracting from its core purpose as money.
And this wasn't just a minor disagreement.
Not at all. It got ugly. And the protest with significant node adoption for Bitcoin knots, the version opposing the change, apparently surged like 60x, hitting almost 18% of the network at one point. So you had this combination: growing surveillance fears, eroding Bitcoin's privacy claims, and this bitter internal war over its fundamental purpose. For many original cypherpunks, ZCash's ZK-SNARKs started to look like the real fulfillment of the original electronic cash vision, truly private, mathematically sound.
Okay, so ideological refugees leaving Bitcoin. At the same time, Catalyst 4 hits. Big money starts dumping Bitcoin.
Perfect timing, in a way. Bitcoin had just hit that crazy peak, around $126,000 in October 2025. Then, almost immediately, a sharp correction kicked in. And the key thing here is who was selling. It wasn't just nervous retail traders. It was institutions.
The big players got cold feet.
Big time. We saw massive outflows from the regulated institutional products, especially the U.S. spot Bitcoin ETFs.
How massive are we talking?
Over $1.15 billion pulled out in just the first week of November 2025. Billion, with the BlackRock's iBeat fund alone, which was supposed to be the gold standard for institutional Bitcoin exposure, saw over $500 million walk out the door.
Wow, that's serious capital flight.
And it wasn't just the ETFs. We also saw data showing long-term holders' wallets that hadn't moved Bitcoin in years suddenly selling off huge amounts. Over 400,000 BTC in November. Historically, that's a really bearish sign, suggesting even the true believers were capitulating.
So Bitcoin is suddenly looking expensive, it's under heavy selling pressure from institutions, and its core philosophy is being questioned. Zcash must have looked like an attractive alternative.
It looked like the perfect hedge, really. Here's this asset, Zcash, with a much smaller market cap under $7 billion when the rally kicked off, meaning it had way more potential for percentage gains. It had a low correlation to Bitcoin and the wider market, offering diversification. And crucially, it had this powerful privacy narrative hitting right when surveillance fears were peaking. While Bitcoin was tanking in early November, ZEC was topping the crypto gainers lists.
Which sets the stage perfectly for Catalyst 5. The celebrity effect, the hype train arrives.
Yeah, this poured rocket fuel on the fire. It really started heating up in September 2025. Naval Ravikant, hugely respected tech entrepreneur, thinker, publicly tweeted his support for Zcash. He specifically called it insurance against Bitcoin for financial surveillance.
Insurance. That's a potent word in this climate.
Incredibly potent. It tied Zcash directly to those macro fears about CBDCs and government control. And the market reacted instantly. ZEC jumped 50% from around $100 up to $148, basically overnight.
Okay, so Naval lit the fuse, but then Arthur Hayes threw gasoline on it.
So, pretty much. Arthur Hayes, the outspoken former CEO of BitMEX, jumped in during October. He admitted he'd been skeptical of Zcash before, but Naval's endorsement apparently changed his mind. He announced he'd bought a few $million worth, and then he dropped the bombshell prediction.
The $10,000 ZEC target.
The $10,000 target, which for a coin that was $15 just over a year earlier sounded absolutely insane. But he didn't just say $10, he said it could happen in weeks rather than years.
Okay, that sounds like pure market manipulation, trying to pump his own bags. Did anyone take that seriously?
Well, it was definitely hype. But it was effective hype because, as we've discussed, the underlying conditions were already ripe. You had the regulatory pressure, the Bitcoin disillusionment, the institutional rotation. Naval and Hayes just provided the spark in the narrative.
And it triggered a short squeeze.
A classic short squeeze. Think about it. Huge buy pressure coming in from these endorsements, driving the price up. But where's the supply to sell? A huge chunk of ZEC, remember, about 30% by this point, was locked away in shielded addresses. It wasn't sitting on exchanges easily available to borrow for short selling.
So less liquid supply available means shorts get trapped.
Exactly. Traders who had bet against Zcash, maybe based on its years of underperformance, suddenly found themselves underwater as the price surged. They were forced to buy back ZEC at higher and higher prices to close their positions, which just pushed the price up even faster. That culminated on November 7th when something like $6.75 million in short positions got liquidated, driving that brief spike up to $748.
Given how fast and aggressive that move was, were there whispers of this being, a coordinated effort, a planned pump?
There were definitely those accusations, but the Zcash Foundation came out very strongly against that narrative. Their leadership emphasized that as a U.S. nonprofit, they operate under strict rules and absolutely do not pay for promotion or engage in market manipulation.
So they attribute it purely to organic factors.
They do. They pointed to the rising shielded supply, the increasing search trends for Zcash, the growing discontent with surveillance. They framed it as a genuine bottom-up movement, finally recognizing Zcash's value proposition in the current climate.
Okay, so we have the regulatory pressure, the philosophical shift, the institutional money flows, and the hype. But a rally like this needs some technical substance underneath it, right? If Zcash is the survivor, let's look closer at the tech. Is ZK-SNARKs proving genuinely superior in practice now? And what were the specific technical weaknesses that Monero couldn't shake?
Absolutely. The rally wouldn't have had legs without Zcash's own technical maturation finally hitting its stride. A huge part of this was fixing the user experience, the UX. For years, shielded Zcash was powerful, but frankly kind of a pain to use.
How so?
You had to manually shield your funds, manage different address types. It was clunky. That friction is why, for a long time, only about 10% of ZEC was actually in the shielded pool, despite the privacy benefits. The big breakthrough came in 2025 with the Zashi wallet.
Zashi. What did it do differently?
The killer feature was auto-shielding. Basically, if you received ZEC to your transparent address, Zashi would automatically, in the background, move those funds into a shielded address for you. It took the complexity out of the user's hands. Maximum privacy became the easy default path.
Ah, frictionless privacy. That sounds like a game changer.
It really was. Zashi also introduced other improvements, like ephemeral addresses for better receiver privacy and, crucially, cross-chain integrations. They built something called CrossPay, allowing ZEC to interact with networks like Solana and Ethereum more easily. It made Zcash feel less like an isolated island and more like part of the wider crypto ecosystem.
And we saw the impact in the adoption numbers.
Definitely. That auto-shielding feature directly drove the growth in the shielded supply from that lagging 10% up to a much healthier 30% of all ZEC by November 2025. And within that, the most advanced shielded pool, Orchard, now holds over 4.1 million ZEC. It showed users would use the privacy features if they were easy enough.
And Zcash is also benefiting from the broader ZK trend, right? Everyone's talking about zero-knowledge proofs now.
Huge tailwind for them. You've got Polygon launching their ZK EVM, Ethereum heavily investing in ZK rollups for scaling. The whole industry is basically validating the core technology that Zcash pioneered 8 years ago. It adds a lot of credibility to their approach.
Okay, so Zcash tech is maturing, becoming user-friendly, getting validated by the market. Now let's flip the coin. Monero. What were the specific technical cracks that started showing, undermining its gold standard reputation?
Well, remember, Monero's privacy is probabilistic. It relies on hiding you in that crowd of mixins. The first big issue researchers found was what they call the anonymity set traceability problem.
Okay.
Monero had different transaction types over the years. Some very old transactions, before they implemented Ring CT to hide amounts, could actually be de-anonymized with enough analysis. The problem was these known old transactions could still be chosen as decoys in new transactions.
So if an attacker knows one of the crowd members is definitely not the real sender because it was already exposed.
Exactly. They can eliminate that decoy, effectively shrinking the size of the crowd you're hiding in, sometimes significantly. It weakens the core privacy guarantee. Monero tried to fix this with network upgrades, but it highlighted a vulnerability.
And there was a second, maybe more fundamental issue, something about how users actually spend their money.
Right. This was the guess newest heuristic. It attacked the way Monero selected those decoy mixins. Monero used a specific statistical method, a triangular distribution, assuming that would create good randomness. But researchers looked at actual blockchain data and found a strong pattern. Most people spend their Monero very quickly after receiving it, typically within about 1.8 days.
Okay. And the selection method didn't account for that.
It didn't properly model that real-world behavior. So here's the attack. If an analyst sees a Monero transaction ring, and one of the inputs is brand new, less than 1.8 days old, while all the other decoys are much older, they can make an educated guess.
Guess that the newest one is the real one?
Precisely. And the research showed this guess newest heuristic was successful in identifying the true spender, something like 81% of the time in cases where it could be applied. The way decoys were chosen was inadvertently leaking information based on typical user behavior.
Wow, that's a pretty big hole. If just observing timing can de-anonymize you most of the time, were there fixes proposed for this?
There were. An immediate suggestion was to just change the sampling strategy, use a mix of newest, recent, old, and uniformly random decoys to better mimic reality and confuse that heuristic. That showed promise in simulations. But the more ambitious long-term fix proposed was a new type of ring signature technology.
Ring CT 2.0.
Sometimes called that, yeah. Technically short-linkable ring signatures. The big advantage. Current Monero signatures get bigger, and thus more expensive in fees the more mixins you add. So users are incentivized to use smaller, less private ring sizes, like the minimum of 7.
Right, a trade-off between privacy and cost.
Ring CT2 2.0 eliminates that trade-off. It offers constant-size signatures, meaning you could have a ring size of 100 or 1,000 and the transaction size and fee wouldn't increase. It would make the anonymity set potentially massive, solving that core problem.
That sounds amazing. Why didn't they just implement it?
The catch. And it's a big one, philosophically, for the Monero community. Ring CT 2.0, like ZCash's ZK-SNARKs, requires a trusted setup, a special one-off ceremony to generate certain cryptographic parameters needed for the system to work.
And the Monero community hates trusted setups.
Vehemently. It
Yeah.
goes against their core ethos of complete trustlessness. Introducing any element of trust, even in a carefully designed setup ceremony, is seen as a betrayal of principles. ZCash, on the other hand, embraced a trusted setup from day one, though they used a very complex multi-party process to minimize trust. So it boils down to that fundamental difference. ZCash prioritized the strongest possible mathematical privacy, even if it required a setup. Monero prioritized ideological purity and trustlessness, even if it meant accepting weaker, probabilistic privacy guarantees that prove vulnerable.
So putting it all together, the engine behind the Zcash phenomenon isn't just internal crypto drama. It's plugged into this much bigger global context, this rising tide of surveillance and control.
Absolutely. The macro picture is arguably the most powerful driver now. And the prime example is the push for central bank digital currencies, CBDCs.
We mentioned 130 plus countries exploring them, and those holding limits.
Right. That concept of holding limits is incredibly chilling if you think about it. It's no longer just a theoretical risk. It's something central bankers, like those at the European Central Bank, are actively discussing, even if framed as a way to prevent bank runs.
Let's be really clear. What would a holding limit mean for an ordinary person?
It could mean the government literally dictates the maximum amount of its own digital currency you're allowed to save. Imagine a limit of, say, $10,000 equivalent. If your digital balance goes above that, the system might automatically convert the excess into a government bond or force you to spend it or put it in a negative interest account. It's potentially a tool for fine-grained control over citizens' economic behavior.
A fundamental loss of financial autonomy.
Exactly. And when faced with that prospect, having access to a private, decentralized, censorship-resistant digital currency like Zcash stops being a niche interest and starts looking like a fundamental tool for preserving personal savings and economic freedom.
Okay, so the macro tailwind is strong. Looking ahead for Zcash specifically, what are the big opportunities now, and what are the challenges to sustaining this momentum?
The opportunities are huge. We're seeing clear signs of growing institutional interest. Look at the Grayscale Zcash Trust. Its assets under management were up 228% in 2025 alone. That's serious money flowing in.
And the cross-chain stuff is expanding.
Yeah, that's key. They're not staying isolated. Over 16,000 wallets now hold tokenized ZEC on other chains like Solana and BNB chain. This helps Zcash tap into the liquidity and applications across the wider Web3 space. And the whole ZK narrative continues to validate their tech. They're well positioned.
But it can't all be smooth sailing after a 1,000% run-up. What are the risks?
Well, the most immediate risk is just volatility. That massive price spike pushed technical indicators like the RSI deep into overbought territory. A significant correction wouldn't be surprising at all. There's also execution risks they need to manage the ongoing transition to their newer core software, Zebra and Zalet, without any major hiccups.
And the biggest challenge long-term?
Sustaining the usage growth, getting the shielded supply from 30% up towards ideally a majority. The Zashi wallet was a huge step, but they need to keep innovating on usability and demonstrate real-world utility beyond just speculation to maintain momentum after the hype fades.
Which leads to that bigger vision question. Can Zcash evolve beyond being just a privacy coin and become something more fundamental, like the privacy layer for Web3, used for confidential computing, private identity, things like that?
That's the ultimate bull case. If Zcash can leverage its core ZK-SNARK technology to enable things like private smart contracts, or secure identity systems where you prove attributes without revealing data, or even confidential settlement layers for institutions, then it moves into a whole different league. It stops being just about private payments and starts becoming essential plumbing for a privacy-preserving internet.
And that brings us full circle back to Arthur Hayes and his audacious call. The $10,000 ZEC question, is that pure fantasy, or is there a scenario where that happens?
Look, $10,000 ZEC implies a market cap around $140 billion. That's massive top 5 crypto territory today. For Zcash to get there, you need to believe in a significant privacy premium.
Meaning privacy itself becomes incredibly valuable.
Exactly. The argument is, as global financial surveillance intensifies, as CBDCs roll out with potential controls, a scarce, technically superior, and regulatory survivable private asset becomes exponentially more valuable. People will pay a huge premium to opt out of the monitored system. If you believe Zcash has the technical leadership, has navigated the regulatory hurdles, and that the trend toward surveillance will continue, then yes, the bull case for that kind of valuation exists. It's steep, but all the catalysts we've discussed point in that direction. #TechOutro.
So the key takeaway for you listening today seems pretty clear. This whole Zcash story in 2025, it's powerful proof that financial privacy isn't just some fringe cypherpunk ideal anymore. It's become a real pressing need, driven by regulation, by institutional demand, and frankly, by the shortcomings of older systems like Bitcoin and the difficulties faced by alternatives like Monero.
Right. Zcash seems to have found that sweet spot. It offers incredibly strong, mathematically backed privacy with ZK-SNARKs, but critically, it built in that option for transparency via viewing keys and IP addresses. That pragmatic compromise is what allowed it to survive the regulatory onslaught that sidelined its main competitor.
It's the approach that fits, maybe uncomfortably for some purists, but fits the reality of today's world.
It seemed to be the most viable model right now. It balances cryptographic integrity with regulatory feasibility.
The pragmatic choice, perhaps?
Which leads us to our final thought for you to chew on. We've just walked through a story where developers creating privacy tools faced serious jail time, and where major central banks are openly brainstorming ways to limit how much of your own digital money you can hold. Given that reality, what does Zcash's survival, its ability to exist as a regulated option for privacy signal about where the line between financial freedom and state control might be drawn in the future? And if privacy does command that massive premium we discussed, what role does a $10,000 Zcash play in preserving individual autonomy in that potentially very controlled future?
A big question indeed. Something to think about. Thanks for joining us on the deep dive. We'll see you next time.